Hey Bowtie Nation, Joseph Hogue here with your weekly market update, 9 a.m. every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, great news on inflation led to a crash in the market on Thursday, but looking deeper, we see that 3 out of 4 stocks, 386 stocks in the S&P 500, actually closed in the green for the week. In fact, Thursday's disruption in stocks was historic. Only one other day since 1979 has seen a bigger difference between small and large stocks, and it could signal a major rotation in the stock market. I'm going to detail what is already becoming the great rotation of 2024 and the stocks to watch, along with updates to shares of Tesla and MicroStrategy. But first, all you out there in the nation know, real estate will always have a special place in my portfolio. I started out as a commercial property analyst, and no other asset class has created as much legacy wealth as real estate. Besides those long-term returns, real estate could be one of the biggest beneficiaries of this great rotation I'll detail next. But I've owned rental real estate and can tell you, if you haven't known the joy of being woken up at 3 a.m. to light the pilot light on someone's water heater, you haven't known the bliss that is managing your own properties. For that reason, I'm investing through the Arrived Homes platform instead, a platform that gives you the opportunity to invest in fractional shares of rental properties. You earn dividends on the rental income paid every quarter, with dividends from 3 to 8% on rent, and then price appreciation when the property is sold. Upside price returns have been as high as 136%, and usually over 5 to 7 years. I know you have a lot of questions. I know I did before I started investing, so I'm going to leave a link in the description to the platform. One thing though, homes available for sale sell out fast, so make sure you click through and just get on the notification list. I missed out on a lot of good properties for not being on that notice list, so look for the link below. Back to our main topic though, and last week actually started out really strong for stocks. In our July 1st update, I detailed the Fed's next move with a stealth cut by talking rates down, and by the close of his 2-day testimony before Congress, Fed Chair Powell had pointed out considerable progress towards the inflation goal and reiterating the Fed's other mandate of full employment to promise that coming rate cut. That alone brought the interest rate on the 10-year Treasury down from 4.3% to 4.28% by Wednesday. Then on Thursday, monthly inflation data showed consumer prices fell for the first time in 4 years on a month-to-month basis, while the price of rent and eating out were both up more than 4% from last year, and car insurance has gone absolutely insane. The price of used vehicles has dropped 10% over the past year, along with deflation in everything from toys to airfare, furniture, and electronics. And okay, before you rush to the comments to rant about how bad inflation is, the CPI is a survey of 94,000 prices each month across thousands of retailers. It is not going to reflect every person's experience, but will show the average. So whether airfare for your flight to Loompa Land fell by 5% over the last year or not, isn't what it's measuring. So the fact is, the pace of inflation on average was surprisingly low, but then the market freaked out. Stocks in the S&P 500, the largest 500 companies in the US, fell by almost 1%, and the tech-heavy Nasdaq plunged by nearly 3% on the day. But it wasn't as bad as it appeared. Because of how those major indexes are set up, just a few tech stocks made it look a hell of a lot worse. The largest 6 companies in the S&P 500 plus Tesla, the Magnificent 7 there, fell an average 3.9% across the group. Because these 7 stocks amount to nearly 1/3 of the market index, they pulled the entire index down with them. In fact, if you smooth out the weights for all the stocks in the S&P 500, so instead of making those 7 stocks 1/3 of the index, they're only about 1.4%, something done in the Equal Weight Index Fund, the RSP, then you actually see the broader stock market was up 2.1% for the day. So it wasn't the stock crash it appeared to be, but a rotation out of the stocks that have been doing well into stocks that are going to take the lead as inflation subsides and those interest rates start coming down. The CME FedWatch tool uses futures pricing to forecast what the market thinks the Fed will do in each of its meetings over the next year. And while the market is still nearly unanimous that the Fed will keep its funds rate between 5.25% to 5.5% when it meets at the end of July, odds of that first rate cut have jumped for the next meeting in September. We can see that just a month ago, the market was pricing in 35% odds that the Fed would keep rates where they are without a cut. Those odds are now just 3.8%. The market is putting 96% odds that the Fed will cut rates by either 0.25% or a full 0.5% cut in September. More than that, the market is now pricing in that once cuts start, the Fed could cut 6 times through next July, lowering interest rates by 1.5% or more. So this rotation out of the stocks that have been favorites and into those that will benefit the most from those rate cuts is not over. The great rotation in stocks has just begun, and I want to highlight 7 stocks to watch and the funds that could do well in that theme. First up here, real estate stocks are the most direct beneficiaries of those lower interest rates. The highest rates since 2007 have destroyed cash flow and values for commercial property, with that pandemic shift to work from home pretty much sealing the deal for office space. We can see in Nareit data here that real estate stocks are down 2% this year after a disastrous 2022 when the sector was down 25% and then underperforming last year. Office space is the clear loser here, and with vacancy rates as high as 30% still in some major cities, I wouldn't touch office property just yet. Now that said, if rates do come down, then we're going to see a lot of money flood into real estate. Lodging and resorts have come off the highs and should do well with the record summer travel season. Telecom REITs, so those cell tower properties, have also crashed this year, but have predictable cash flows that make these good deals right now. To give you a sense of the sigh of relief by real estate investors on Thursday's low inflation data, the Real Estate Sector Spider ETF, the XLRE, jumped 5% on the week. The fund is a broad mix of the real estate stocks in the S&P 500, so 31 REITs in all. And you can see it only has about 0.92% exposure to office REITs, so you don't have to worry too much about that if you want to just buy this whole sector. Within the individual REITs, though, you might look at Host Hotels and Resorts, ticker HST, with its 4.5% dividend yield. The company owns 74 premium properties, mostly in the United States, totaling 42,000 rooms across the Marriott, Ritz-Carlton, Westin, Sheraton, and Four Seasons brands. The Host is only expected to grow funds from operations, or that FFO measure, by 1.9% this year, which is slower than the others in the group, but these are all quality properties and trading for less than 9 times on a price to FFO basis. I also like cell tower REITs like Crown Castle, ticker CCI, which has sold off this year, but these are low maintenance, stable cash flow properties, and the valuations are really good here. Their shares rocketed up 8% last week, but are still 11% lower from the beginning of the year. CCI is expected to increase funds from operations by 22% this year, with the shares trading for a price of less than 6 times FFO. On the strength of AI and computing needs, I also think data center REITs like Digital Realty can provide solid dividend cash flow and price returns. After real estate, regional banks will also benefit from that rotation and the lower interest rates, with the Spider S&P Regional Banking ETF, ticker KRE, up 8.5% last week. Regional banks will benefit in 2 big ways with those lower interest rates. First, the value of their bond portfolios will rise, pretty much the opposite of what we saw in that SVB crisis. Also, though, regional banks hold the loans on most of the country's commercial real estate, so a rebounding property market will take a lot of pressure off these banks. We could also see a return to the pandemic growth darlings, like my favorite SoFi Technologies, ticker SOFI, which was up 13% from this week's low. Here, I'd also be looking at stocks like UiPath, Shopify, and Unity Software. What you're looking for here is companies with that double-digit sales growth, so strong revenue growth, but maybe not profitable yet. Because most of the cash flows for these growth stocks are far out into the future, when analysts value them with that maybe a discounted cash flow model, the interest rate used is very important. As interest rates fall, the value of those future cash flows increases, and so does the stock price. It's really the opposite of that growth stock massacre that we saw happening in 2022 as rates increased. Small cap stocks in the Russell 2000 index boomed last week, with the iShares Russell 2000 ETF, ticker IWM, finishing 5.5% higher. In fact, Thursday was only the second day since 1979 that the small cap index beat the S&P 500 by more than 3%. And these small stocks beat the Nasdaq by more than 5%, something that has never happened before. Smaller companies are more sensitive to interest rates, so that's the prospect of those rates come down, the financial forecast for these companies and the index run higher. Now, these aren't the risky penny stocks we've talked about on the channel, though. All the companies within that IWM index fund have a market cap of at least $2 billion and as high as $10 billion, so we're not talking too much risk here. Another fund to give you that broad exposure to this rotation theme is the S&P 500 Equal Weight ETF, ticker RSP, which holds all the stocks in that large cap index, but in an equal amount to each. I've been using this fund as a part of my core market investment for the last few months, trying to broaden my exposure to that entire market. You see the problem when you look at that market fund like the SPY, which tracks the S&P 500 index. Nearly a third of your money is in just those 6 stocks: Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet. And while they've done really well this year, those Mag 7 stocks are very expensive. Looking at the holdings in the RSP though, and you see it's spread out equally across the entire index. And while the market-weighted S&P 500 fund, that SPY, has outperformed since January as the Mag 7 group just kept going, the RSP shot past it last week with a 3% return versus just 0.9% for the SPY ETF. If we do continue to see that rotation and that broadening out of stock returns, this fund will outperform the tech overweight in the S&P 500. Turning it now to the stocks I'm watching this week, Tesla Inc., ticker TSLA, broke its 11-day win streak that added $172 billion to the market value of shares when it announced a delay to its robotaxi news scheduled for August. I highlighted the EV stocks I'm buying last Monday with Rivian, ChargePoint, and EVgo all up double digits in the past week. Tesla could still be a good long-term buy here, but I'm afraid that near-term excitement is going to continue to turn to disappointment when investors realize that robotaxi revenue is much further out than hoped. SoundHound AI, ticker SOUN, saw its share spike 46% last week when the AI software company announced its voice assistant is now integrated into production for Peugeot, Opel, and Vauxhall vehicles across 11 European markets and is going to be in 17 markets by the end of July. I've been buying shares here since February, just before it announced that Nvidia had bought a stake in the company. The sell-off over the last month saw some investors exiting the shares, but I still think this is going to be one of the best stocks for that next wave in AI. MicroStrategy Inc., ticker MSTR, announced a 10-for-1 stock split last week, something I pointed out 3 weeks ago in a 10 stocks most likely to split next video. The shares got hit in that Bitcoin sell-off over the last 2 weeks, but got a good boost late last week on that announcement. The split is going to happen in August 8th, so anyone with the stock before that date is going to get 10 shares for every one they held. We could see more support for that price over the next couple of weeks as investors position in for that split. Showing you that bigger picture idea here with the SectorSpiders.com sector tracker. 10 of the 11 stock sectors actually did finish higher last week with a great signal for health of the bull market, though not for all investors. Stocks in 6 of the sectors jumped more than 2% on the week, displaying really broad strength to the market on that slowing inflation. The problem for many investors is their portfolios, just like that S&P 500 index, are overweight in those biggest tech stocks like the Magnificent 7 names, the stocks that are now giving back some of those gains. Even in that rotation theme, I don't think you should avoid those big tech stocks as they still dominate those biggest drivers of the economy and the future trends like AI. If your portfolio is overweight though, say 25% or more in these Magnificent 7 stocks, so that's Apple, Microsoft, Alphabet, Tesla, Amazon, Nvidia, and Meta, then consider broadening that out with some other stocks in today's main topic. Also, one very important sector to watch as we move into the second quarter earnings is going to be consumer staples, stocks of companies that sell necessities like food and beverage and household goods. PepsiCo may have been a warning when it reported earnings last week, missing forecasts for earnings and sales as consumers really pull back in the face of higher prices. Pepsi reported a 4% drop in volume sold compared to the same period last year. Total sales also increased just 1% from last year and with 2% drop in volume just in the second quarter alone. Conagra Brands also missed its expectations and issued a disappointing forecast in its earnings report on Thursday. With consumer spending accounting for more than 70% of the economy, if consumers do slow over the next couple of quarters, the economy may come out weaker than expected and weigh on stocks. Check out the Arrived Homes platform, how I'm investing in real estate right now, with the link in the description below. And don't wait, get on that wait list now. Or click on the video to the right to see the 5 stocks Nvidia is buying for the next wave in AI. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.